Markets are closed in the U.S. in observance of Martin Luther King Day, but Peter Hug still has a lot to say about gold, silver, and PGMs this week. Up next. So markets are closed, but doesn't mean we don't have many things to talk about. Peter, thank you for being with me.
You're welcome, Daniela.
Peter, let's start off by talking about the PGMs and especially platinum. Last time we spoke, it was at $1,550. You said that was a good buy opportunity. Do you think that we need to pay more attention to the PGMs right now, especially platinum and palladium?
Well, it really depends on the psychology of the investor. PGMs are a more demand-supply type of issue, specifically platinum, more so palladium. We caught the platinum trade at $1,550. I was pretty aggressive at that level. I have lightened up in the high 1690 range. Platinum may be a little ahead of itself. Palladium, I think through 2013, if you're anywhere somewhat bullish on this economy and the global recovery, I think palladium now anywhere under $700 is probably an excellent buy for the remainder of this year.
And Peter, when you buy the PGMs, are you buying physical or the paper?
Well, again, I'm a trader, so my concern isn't that the U.S. government is going to confiscate my metals. My concern isn't that we're going to have Armageddon in the Western world. I'm a trader, so I'm looking for capital gains. When you look for capital gains, you look for the most inexpensive way of entering a trade, which still is the futures market.
Peter, what do you think really caused that upswing we saw in platinum? Was it the troubles we were seeing in South Africa?
Well, I think that had something to do with it. I think the Russians tend to play games. They've been playing the games since the 80s. They withhold delivery on their contracts, suggest that supplies may not come to the market as freely as expected. And when you look at the overall net production of platinum and palladium and rhodium for that matter, and compare it to what the expected demand is, you can make a strong argument that there's going to be a deficit in 2013. And given some of the economic data we've seen out of the United States, which suggests that the economy is starting to turn, which would be very positive for the auto industry, that supply deficit situation is price positive for the PGMs.
Okay, next topic, Peter, silver. And could we see a modern day silver rush? News coming out last week that the U.S. Mint has temporarily halted sale of their silver coins. What does this mean?
Well, I think the U.S. Mint, based on their sales from 2012, was not expecting the surge of demand in the early part of the year. I just don't think they were ready. I don't see that same issue with the Royal Canadian Mint. They seem to be able to produce silver maple leafs. I think they were better prepared. I do think the premium on silver eagles will go up in the short run. The U.S. Mint has suggested that they might restart allocation the week of January 28th, but they have not confirmed that. And the longer that they wait to get allocation into the primary dealer market, the tighter, obviously, the supply. In most cases, there's dealers out there now that have no supply of eagles left, and that will result in a short-term hike in the premiums.
Peter, let's turn now to gold, and news coming out today that India hikes its import tax on gold by 50%, increasing from 6% from 4%. This is effective immediately. Who would this impact the most?
Well, I think it'll have an impact on gold, physical gold buying in India. I mean, the trend has been put in place since the beginning of last year, and it seems to be continuing. Not in the same camp with a lot of analysts that suggest that that's going to be the final catalyst that'll bring the gold price down. I tend to get myself into trouble as a trader when I read the various blogs that have been around, quite frankly, for 30 years. I mean, there are certain individuals in this market that are entrenched in their bearish view, albeit gold having doubled and in some cases tripled within their context of being bearish. And I have the same context on the bullish side where you have the same individuals, I won't name them, that have been calling for $3,000 gold since 1979. I mean, I think if you look at the dynamics of the market, there's very little that has changed. I mean, the governments, the Western governments are still printing money. There seems to be a situation in Washington that does not look like it's going to resolve itself. We have a fiscal cliff issue coming up again in about 45 days. We have the debt ceiling coming up. We have huge budget deficits that are debasing currencies, not only in the United States, but will also debase currencies in Europe and in Japan. I mean, you just have to have a portion of your portfolio in hard assets to protect yourself against the events that probably will continue to unfold through 2013, 2014. As a trader, it's irrelevant to me whether gold goes to 2,000 or to 1,400. I think you have to trade the price points. Silver was a buy at 1630, which we suggested the last time I spoke. If it gets through 1703 and then through 1720, again, those are points where I would take money off the table. I see 1750, and silver will follow right along with it from a perspective of where the gold price goes. I think gold is the leader here. Silver may outperform in percentage terms, but all eyes are on gold.
Peter, do you think gold could hit the 1,700 level this week, and if so, test 1,715?
Again, if I'd like to see a close over 1703, which would put my next trade to 1720. A close over the 1720, 1722 level, in my opinion, would test the 1750. Don't think that'll happen this week, but it's if we can get those two closes, I certainly think it's in the cards before the end of January.
Finally, Peter, you mentioned central banks, and I know you're a native of Germany, so what do you think about that news item that Germany wants its gold back and is looking to move its gold from New York and Paris back to Germany over a 7-year term? Germany is the world's second biggest holder of gold reserves. Is this a big story, Peter?
No, I think it's a non-story. I mean, Germany moving their gold reserves from France to Germany makes total sense. I mean, why wouldn't a central bank of Germany hold its own gold? They're taking a portion of their gold from New York back to Germany over a period of 7 years. I mean, if this was a story where Germany said they are repatriating all of their foreign gold reserves by the end of 2013, I'd be looking a little deeper at the story. The fact that this is happening over 7 years, again, gives the writers something to talk about, some conspiracy theories to talk about, anything to create some following within their readership parameters. I personally think it's a non-issue.
I guess, Peter, the rumblings coming out of the blogosphere is that this shows distrust for central banks.
Well, I mean, if the Germans distrust the French, they've distrusted the French for hundreds of years. So I don't consider that anything new. I don't think the Germans distrust the Federal Reserve. If they did, they would withdraw all of their gold, not only a third of their gold. Again, it's inconsistent. If you don't trust somebody, why would you leave them with 2/3 of your assets?
Peter, and that's a good point. It is taking place over a 7-year period, not a shorter time frame, which could have caused more concern.
Yeah, I mean, the Germans, they have a central bank. They have their own vaults. Why wouldn't they hold their own gold reserves? It makes total sense to me. I mean, I don't see anything sinister in the concept.
Well, thanks for bringing logic into the precious metals world, Peter.
Logic. I do the best I can with what I have. Thanks.
Thanks, Peter. See you next week. And thanks for watching this edition of For Pete's Sake. You can email me any comments or questions at newsfeedback@kitco.com or tweet me at Daniela Cambone. Thanks for watching.